So here we go with Chapter 9, valuation of stocks. Primary takeaway from this particular chapter would be those factors that appear to influence stock price. As you remember, in the very first chapter, we started talking about the ultimate goal of management of a company is to increase the wealth of its owners, to maximize share price. So hopefully we can get some insight into factors that may impact that. So if we look at a one-year investor, right, you're going to buy stock at the beginning of the year. At the end of the year, you're going to sell the stock. If we knew the future dividend, or the dividend to be paid in the next year, and if we knew the price at the end of the year, we could then calculate the required return to get this investment. So again, if you think of our basic formula as a time value question, the current price, this piece of 0, should be equal to the cash flows over the time period for 1 year. And it's a time value question, so the required return is the equity cost of capital. So this equity cost of capital is the required rate of return on the investment. So we need to solve for that. So when we solve for R sub E, we end up then with a formula that has the cash flows at the top divided by the beginning cash flow minus 1. This is actually our holding period return from a previous chapter. But the nice part of this formula is it decomposes the return into the two logical components for valuing or for buying a stock. You buy a stock for its dividend yield, the return you get from the dividends that are received. Then you also buy a stock because you want to see capital gains. So the expected total return of a stock is equal to the expected returns of other investments that are available in the marketplace at the equivalent risk. That is the law of one price that we've been talking about. So this dividend yield and capital gains rate, they should be equivalent to similar investments, similar types of risk elements that we could possibly find in the environment. So if we look at the stock, here's Walgreens. They're going to pay a 44-cent dividend. They're going to trade for $33 at the end of the year. That's what we expect to happen. Investments with equivalent risk get an expected return about 8.5%. What would be the rate of return on this stock? Well, plugging into our formula, we have a price of around $30.82. At that price, what would be the decomposition then, right? So again, we have the dividend yield is the dividend divided by the price of $30.82. So the dividend is 1.43%. The expected capital gain then, $2.18 divided that is 7.07%. And if you divide those two things together, that equals this expected return. So at least it appears, right, that from the basic formulas, again, this is a contrived kind of a textbook example, but there is a relationship between the dividend yield and capital gains and the returns that the stock should ultimately receive. What if we have more than 1 year, though? Obviously, we have the assumption that we ultimately want to make is that stocks last forever. But again, if you think about how this calculation works beyond 1 year, right, multiple years, we need to have some kind of an understanding of all of the dividends that are received to the end of the holding period. And we need to know the price at the end of the holding period. This ultimately is referred to as something called the dividend discount model. So we want to make an assumption. The first assumption is we need to make an assumption that this price, which we don't know what it's going to be, we have to kind of eliminate it somehow. So the assumption is that stocks have an infinite lifespan. At infinity, anything from infinity to today, present value context, equals 0. So I don't need to know the future price. That still says I need to know all the dividends from now to infinity, and of course That creates its own problems, right? How do you do this to infinity? Well, what we ultimately get is another assumption. We're going to have an assumption. It's called the constant dividend growth model. This was devised by a guy named Gordon, so sometimes it's referred to as the Gordon model. But we have the future dividend, d sub 1. If you divide that by the cost of equity minus the growth rate of future dividends, we can find the value of a stock. Of course, we don't know what D1 is, but our assumption is, constant dividend growth model, is that the growth rate of future dividends is constant. It's fixed. So now, if you know today's dividend, you know what next year's dividend is. If today's $1 and you say that the growth rate of dividends is 6%, next year's $1.06. The year after that's $1.12, and so on and so forth. So we have a formula basically says, look, you need to know three things. You need to know the current dividend, you need to know the cost of equity, and you need to know the growth rate of future dividends. Well, we're going to talk about as we go through this, how do you find those numbers? Of course, we could just, if you solve for the required return or the cost of equity, we could solve for that, but we still have this growth rate hanging out there that we really don't know what that is. So before we move forward, let's talk about what the idea here, or the concept. The value of the company depends on the current dividend. It is required, or it is dependent on the cost of equity, the riskiness of the company, the cost of financing in the economy. And finally, it is dependent on the growth rate of dividends moving forward. So if I can have influence on any of those things, then I can have influence on the value of the firm. So here we have a company has a constant dividend, right? We have this company, it pays $2.36 is what it's going to pay next year. If its equity costs 7.5%, dividends are expected to grow by 1.5%. What's the value of the stock? Now in this spreadsheet, stock valuation spreadsheet, there is a line that fits this specific problem. It only fits this problem. And that is this. It says the dividend is next year's dividend. You rarely are going to be given this except in a textbook context, but it's there. So if you're given next year's dividend, it says if D1 is given, enter it here. You can enter there. But you have to remember to eliminate that or delete it when the problem is over. In this case, the value of the stock is $39.33. What if the stock was selling for $59? It's obviously what? Would you pay $59 to get $39? Obviously not, right? If you did pay $39, you'd earn 5.5%, but you wanted 7.5%. So this is a bad investment relative to this constant dividend growth model. Another company, it recently paid a $3 dividend. Going to grow at 7%, has a cost of equity of 16%. So this stock has a value of $35.67. What you'll notice here is they tell you you just paid a dividend, so that means we need to know D sub 0. So it's $3. When you plug in the growth rate here, it ultimately recalculates or calculates D1. So in this case, what's 7% of $3? It's 21 cents. If this stock trades at $37, would you pay 37 to get 35? The answer is no. If you did buy this, you would expect to earn roughly 15.67%, and of course you wanted 16%. So again, this XYZ Corporation, again, is a company that you would not be interested in buying this stock. So let's kind of move forward and think about this idea of growth, right? What is the thing called the dividend payout ratio? It's just the fraction of earnings that are paid out as dividends each year. Again, if you think earnings per share is the profit, what does a company do with profit? It either retains it or it pays it out. So as a percentage, dividends per share divided by earnings per share tells you what the dividend payout ratio is. If we can assume that the shares outstanding is constant, right, doesn't change very often, how can you increase dividends? You either increase earnings and keep the payout ratio the same, or you keep earnings the same and you increase the dividend payout ratio. So those are things obviously that management can do to have impact on dividends. How's this simple model of growth ultimately work? Well, what happens with new investments, right? The company retains earnings, they invest in new assets, and there's a return on those assets. So this new investment ultimately equals whatever the earnings are times the retention rate, the percentage that's saved times the return, the earnings that are generated. So the earnings growth rate is this change in earnings divided by earnings. We can ultimately expand this, so we know that the growth rate then, the earnings growth rate, is the retention rate, how much you keep, times the rate of return on the new investment. The rate of return on the new investment, we can substitute for that. We can put in there the return on equity, if you will. What's the return on shareholder money? Multiply that by how much money has been retained. That should give us an indication of capital gains growth in the company. If you keep your retention rate constant, then the growth rate in dividends will be exactly equal to the growth rate of earnings. And we had talked about this before. How do you get dividends to grow? You can make more money, or you can change the percentage of dividends paid. If a company, let's think about this though, if a company wants to increase its price, should it cut its dividend and invest more, or should it cut its investment and increase its dividend? Well, there's some observation to that, right? I mean, if you look at companies in general, when dividends are increased, stock prices rise. But what is the implication of that? What does that ultimately mean for the company? If the company has profitable investments, then if you cut the dividend, the stock price will go up, but it will go up if and only if the new investments have a positive net present value. That is also, though, if and only if there's information to describe why they're doing this. I mean, imagine a company just says, look, we're going to reduce our dividend by 50%, and that's all they tell you. Your imagination would run amok with wondering what's going wrong inside the company. However, if they say, look, we're going to hold back our dividends because we have this great investment opportunity and we want to pay cash for the opportunity. So if this is a good investment, if it is a good opportunity for the company to gain profits, to increase the size of the company, and we don't have to finance this outside the company. There's no risk from borrowing. There's also then no new shareholders that we have to share this opportunity with. So that is going to be seen as being a good thing by investors, and of course they might not mind as much. So we have this crane company. They're going to have earnings per share of $6 in the next year, right? Rather than invest them, they're going to reinvest those earnings and grow. They're going to pay out all the earnings as dividends. With those expectations, obviously, there can't be any growth. So Crane's current stock price is $60. What would happen if they cut its dividend rate to 75%? The return on investments in stores like this are 12%. Assuming its equity cost of capital is unchanged, what impact would this have on the stock price of the company? Well, first of all, let's figure out what's the cost of capital of the company. We know that $6 is the earnings per share, stock price is $60, the growth rate's 10%, and since they're doing 100% payout, there's no growth, so the cost of equity is 10%. So what happens with this new policy? If it reduces its dividend 75%, it's going to go down to $4.50. At the same time, because it's going to retain 25% of its earnings, there's going to be some growth. So the growth rate is going to be 3%. So if we can continue to grow at this rate, right, we can compute the new price. The new price ultimately is the future dividend, that's the $4.50, but now it's the cost of equity less the growth rate that's implied from the reinvestment of money. So now our price goes to $64.29. So it goes from 60 to 64.29. So obviously in this case, it would be a good idea for the company to decrease dividends and reinvest the money in these particular projects. Now, that information still has to be portrayed to shareholders for this ultimately to be seen as a good thing